We go. Hey, everybody, this is Rob Keens of goldsilverpros.com. We have a very special first-time guest on the program. It is Andrew Maguire. He is a metals trader in London, also a director of Kinesis. Andrew, how are you doing today?
Rob, it's been really nice to be with you. First time, and I won't be the last. I really love your work. You've done an awful lot of good work, and I know you're getting a big following. And I think what it is, the kind of subscribers that you have, it really has brought in some very interesting people who've done a lot of work in research and one thing and another, which you report on. So yeah, a pleasure, an absolute pleasure to be with you.
Well, thank you very much for joining. It's exciting for us to have you on. We followed your work for years. Of course, I know that you've been at King World News and on the what I call the interviews circuit, speaking with many people, and I've listened to your work for such a long time. So thank you for joining us. So there's a lot to talk about in the gold and silver space. And so we actually had a long list of subjects. I don't know if we'll get to them all today, but I wanted to start off with sort of the hot one. It's Basel III, because we're in the month of June, and some of the Basel III regulations with regard to the London LBMA are going to start taking effect, even though, well, they'll start taking effect in Europe now, and then maybe the LBMA early next year. What is your thoughts on Basel III? How is it going to affect the London market? Is it the end of that market, as some have said? Is it maybe just a shifting of the way the trading is going to go, or what are your thoughts on that?
Yeah, great question, and a great place to begin, because it is the elephant in the room, really. I mean, we have to remember, I think most people will know that these Basel III banking regulations were drawn up following the 2008 financial crisis. And really, what was it about? It was about attempting to eliminate massive derivative-driven interbank accounting risk. Where's the largest risk? People don't realize how big the derivative gold market is. And although we're talking about, probably 15 trillion but if you account for derivatives, it's actually exponentially higher than that. So obviously, if you want to address anything under Basel III, we're not talking about a small market here. We're talking about a market that actually perhaps even dwarfs the oil market from time to time. So really, Basel III is attempting to unwind this risk. And so, I mean, if you think about it, we see, look, it's going to be too expensive. Bottom line, it's going to be too expensive to finance approximately 600 tons of unallocated gold contracts cleared by the LPMCL every day. And that's right on their website. It's there to see. And we know, Robert, this is not real physical being settled. You know that. It's really just netted out. It's just unallocated gold credit netted out on a daisy chain of LBMA members banks. But these transactions clearly have to be sanctioned as by officials. There's no way that you could net out this amount of risk amongst banks without any real physical to back it up. Now, we're quite certain that this, what we call really working stock, is sanctioned by the BIS, and so it revolves. We know that the BIS leases and swaps and physical metal, supposedly physical metal, but these positions are actually laid on the books of the LBMA banks, privileged to have gold accounts for the Bank of England. Now we're absolutely certain, because we're in the wholesale market and we're in touch with every major desk, and we're in the wholesale business looking to buy and sell physical, and none of these leases ever come up, these swaps ever come up in physical form. And so we know that this has to be unallocated. It has to be laid on the books of these banks, and probably they will be bailed out at some point with these liabilities. So really, I think, you're wondering, well, can this be shifted to another jurisdiction? I really don't think so, because, really, when you think about it, these rules have actually already been adopted by the US, all through Europe, Asia. I think a lot of people weren't aware of the fact that the US adopted these rules a long time ago. And I think there was something recently published to confirm that. I think the OCC issued a statement said 1st of July, US is compliant. Well, actually, I think it was already scheduled to be compliant. So really, other than London, which we know bought 6 months of grace to adopt these physical conditions, there is nowhere else to shift. When you think about it, 100-to-1 leveraged gold credit, where are you going to shift it? Well, certainly not China and Russia, nor can you shift it to the COMEX, because the paper to physical arbitrage potential would simply fracture the exchange for physical mechanism between the COMEX and of course the over-the-counter markets, which are 10 times the size of the COMEX. So I think the first bullish aspect of this unallocated unwind is that this will drastically reduce the volume of 100-to-1 gold, which is really diluting the what is essentially a bilaterally settled deliverable foreign exchange gold contract. So, also physical gold hedged from currency risk in Basel III will be weighted as a cash equivalent asset. So in other words, if you've got physical gold and you've hedged it in for currency risk, it's cash. So that's a first, and this is really powerful. So really, this can only be beneficial for gold buyers and sellers. It's going to help to discover a real physically driven gold price balance. And we already know that, look, there's no money to be made in plain vanilla gold bullion banking. And if you can't exempt yourself from Basel III, and without the smoke and mirrors cover of hundreds of tons, so we just sanction gold credit, insiders cannot control the gold and silver game, because novel, you have to have the bullion to deliver if you sell it. And really, Rob, I see no backdoor here to answer your question.
Okay, so you think you may be along the lines of Alistair McLeod, that you think it's going to have a really big effect on the London gold market?
Absolutely, on the global gold market.
Gold market.
Yeah, because really London kind of, obviously we've just been through another fix here, and obviously that fix determines the spot price, as we know, and that spot price then is the benchmark for bilateral trades. And obviously the bigger the amount, obviously it's a benchmark. It's a benchmark only. When you think about it, 600 tons got cleared today on every day. What I think I had a look a little while ago. I think it was not even 5 tons on an average day of physical transacted. So yeah, I think this is going to have a massive effect on the market.
Okay, and in terms of the currencies, this change in the gold market, how's it going to affect fiat currencies, especially the world reserve currency, the dollar? You think it's going to have an effect on the dollar?
Yeah, I think it really will. I think, look, we've just experienced a 50-year war on gold. I mean, look, and we know the COMEX was formed 2 years after Nixon removed the gold dollar peg. I mean, so really what we all know what was happening. Other central banks were saying, I'll take that gold. Thank you very much. I'll swap these dollars and we'll take the gold. And, you're financing wars. You're spending too much money. Yeah, of course, we'll take it. So he shut it down, as we know. So the COMEX was instigated, as we know, to create volatility, to create really unlimited supplies of paper gold to control the price. Well, I think we've come full circle now. And I think what's happened is it's bit back. And I think what's happened is that because we've had essentially all the other competing global banks, central banks are now moving back to saying, look, I can see this dollar price. Thank you. There it is. That's pretty cheap, actually, compared to where we really think it's valued. So yeah, okay, it's not $35, it's not $45 as it was. No, but hey, $1,900, that's cheap when we think about the big global war. And I think it actually, wars don't get fought in nuclear form, thank goodness, but they get fought in the financial markets. And I think this is an attack on US dollar hegemony. It's coming. I think the Bank of International Settlements is actually bringing these rules in these regulations in to really kind of stop this attack on the US dollar. And look, we know that the United States relies on the dollar's special status, exorbitant privilege, right? And obviously we're looking to fund massive public and private borrowing. And with the Fed completely boxed in, I think there's no argument. They've got to pursue this mandate. Look, we now see that the US on the back foot without moving themselves to allow an upside sanctioned US dollar price revaluation. I mean, there's a multitude of reasons for that, but I think the BIS are actually facilitating this action. But, you know, to give a timeline on this, it's difficult to give a timeline, but given the recent moves by China and Russia to diversify US dollar holdings into physical gold, I think it's going to be about, my view, from a wholesale market perspective, talking to all the liquidity providers around the desk that we deal with, they're figuring, hey, look, it's got to be 3 to 6 months to see a real physical price emerge, and it will happen in stair steps. Now, look, we're moving into fresh territory here. So, you know, it is all new to all of us, really. So, you know, no one's going to pick a price and say that's what it's going to be. But we don't think it's a coincidence that China lifted the cap on imports last month. And rumor has it, as of a couple of days ago, it's going to do this again. And Russia has also ramped up its gold acquisition strategy. And so this is the attack on US dollar hegemony that I'm sure is underway. Look, they last week, what they announced, their National Wealth Fund, they said they were divesting their dollar holdings as part of a process of diversification into euros and one thing and another, but also in a move to buy somewhere between 300 and 400 tons of physical gold. That is what we're hearing. And look, I really do not think it's a coincidence that this directly follows China lifting the cap on official gold imports. I'm sure this is coordinated. And so I think how that would roll out, I don't think Russia's going to come in and buy 400 tons, 400 tons on the open market. I think what they'll do is divert Russian mine supply into sovereign coffers. And I think what that means, though, is that when we go to a refinery, we're going to be limited to that supply, and that's going to affect global supply, which has to have an impact on price. I mean, that's proper, real, physical demand. So whichever way you look at these developments, I think these factors send a clear message to global central banks and sovereigns that gold is being competitively accumulated to back up their respective currencies, but at current US dollar prices. And that's the key issue here. Look, there is a fair price for gold, but it's far too cheap in current US dollar price terms. And so really, and then you hear a lot of argument, people say, yeah, but you know, hang on a minute, look, massive global dollar holdings, Russia's share of the US dollar divestments could be, I mean, look, it's going to be fairly ineffective. Yeah, but what people are forgetting is that gold trading in physical form is actually already priced at the margin. And so it doesn't take much at the margin in physical form. So to actually drain gold liquidity, you know, paper gold liquidity, and that's going to evaporate into this ever tighter supply of physical gold, again, at current diluted prices. So we see tightening available supply is going to force a much higher US dollar gold price. It is a no-brainer. And actually, if we look at it, we saw, I think last week, the bank participation report. Now, to be honest, I rarely look in real detail at the COMEX numbers, which are reported, of course, to Basel III as well. But the bank participation report was a little bit interesting because it actually tells us, it kind of lets you look back a bit from all this chart chatter and an absolute ridiculous unnecessary volatility. And what it did is it reveals that the US banks' gross short positions have reduced by 61,000 contracts and net shorts by 51,000 contracts into a over $200 price rise. Well, what does that tell us? And then, of course, on top of that, we got Bloomberg a week ago saying that the BIS has been buying physical gold. And really, all of these footprints suggest that the BIS has caved into pressure, really, I would think, from China and Russia, telegraphing through their actual actions that they're accumulating gold to back up Russian ruble and Chinese yuan. So, look, I do think this is an attack on US dollar hegemony. I think it's moved center stage. And so while we've been looking at the trigger points for China to disclose what I believe is 25,000 tons, I think Alistair McLeod thinks that. I think several of us think that. And I think perhaps, Rob, you might have an opinion on that. But we think in coordination, Russia is now beginning to play their gold hand too.
Yeah, I think you may be right. Hugo Salinas Price came out in an article on a Mexican site, basically stating that the Russians and the Chinese, according to his intelligence, had threatened to back their currencies with gold and come out in the open on it. And that's what's kind of forced the hand of the Basel regulations, and why now the London market may be coming under pressure in order to get their house in order. So very interesting news that you have there, and a confirmation from an independent resource that a lot of people respect as well. Andrew, I wanted to move the conversation over to the physical shortages, because you mentioned that there a second ago, and we've had, again, some more footprints, as you say, with regards to the physical. There's three of them I want to give here. Former U.S. Mint Director Ed Moy said on Kitco and on April 29th, he believes that the world's major mints are basically out of gold. We recently did an expose on the Perth Mint, along with the CFA, Daniel Vigario, who practices in the UK, on 7 years of financial statements for the Perth Mint, and they're net short to the tune of about 900 million Australian, and they've borrowed 6.5 billion additional precious metals to meet their demand. Then you have the LBMA, which in March of 21 had this 3,300 ton error in the physical silver market, or a misstatement, which they had to mark down their March inventories. So are these all signs that we have a brewing shortage of physical gold and silver at the current demand?
Yeah, and I'll give you my wholesale. I did a check all my wholesalers today as well, and sort of give you an update across Europe, Switzerland, what's going on. But I think what was so interesting, the takeaway I got from his interview was, one of the things he said was that the spot price hasn't caught up to gold's and silver's premium adjusted price. And the main reason is that the overall markets are flooded with bullion derivatives. And then he said, I think he said, there's only a matter of time before the short contracts keeping the price down will expire. Well, actually, I think that's pretty right on. And if we think about that, we're just talked about a great deal of reduction of over-the-counter, of open interest, of COMEX open interest. But this also relates to over-the-counter hedges. So I think what is left now isn't necessarily naked. I think what we're seeing far, far more is the actual, we're seeing legitimate hedging from over-the-counters, longs seeking to actually hedge their positions on the COMEX. So, so what we're seeing on the wholesale front is very strong T+2 gold and silver demand, which underpins dips. So in other words, if I want physical as a wholesaler, I go to the market, I lock in my spot index, my price on the spot market today at the fix, bang, that is my price. I demand delivery in 2 days, and a few cents later, as long as it's not too large a size. And once I get into a ton or more, if I get even into half a ton or more, then we're talking about a premium, a significant premium. Now, specifically, as of today in Europe, the secondary market is absolutely dry for immediate delivery. The primary market is evidencing much higher premiums for delivery and delivery delays at our refineries. And I think today I looked at the American Eagle, $6 above spot. I don't know where they are in the US, but a 1 ounce gold coin, no particular description, 8% above spot. Wholesale bars, I can get wholesale bars, but size will have to be bilaterally settled as stock is being rationed to best clients. So if you just come along and you're not a regular client, you're probably not going to get what you want. And wholesale silver for delivery at current prices, now much like Sprott is doing, much like this COMEX banks are doing, we're having to hunt it down at the refineries at a premium. And and that includes big premiums for US banks who are buying it in places like Russia, who are then literally grabbing anything they can and paying the delivery costs into the US. So significant premiums by the time you've paid everybody's juice.
Yeah, I agree with you. The retail market has gone crazy, especially in silver, since the Wall Street silver and the silver squeeze movement we had earlier this year. And I think we've seen those premiums here in the US on everything gold that you can get from a retail investor perspective. You know, Andrew, over the years, I wrote in 2010 on Seeking Alpha, a very big financial site, mainstream financial site here in the US. I wrote a 5-part series on the suppression of gold and silver. It was posted on GADA's website. And I was credited by GADA as being one of the first people in the mainstream to talk about the manipulation issue. I know you've been talking about this for a long time as well. Many people see the subject of precious metals manipulation as a conspiracy theory, but I argue that data is very prevalent there. Do you think now, 10, 12 years, 13, 14 years later, after you've been talking about this, that the narrative has changed, that people are starting to realize that there has been manipulation at all? Or do you think that we're still in a spot where it's really a blind spot for a lot of people?
I think that, yes, I think it's beginning to become more mainstream. And if you remember, and I know you've been around a long time, I know that you've been talking about this for a long time, but I think from my perspective, back in 2009, we were almost ridiculed. How could it's not possible? This is a conspiracy theory. This is not plausible that an entire industry could actually coordinate prices. And look, we were shouted down, I'm sure you were as well, by everyone in the industry, or just about everyone in the industry at the time. It's funny how, other than one or two remaining industry apologists, say nameless at this moment, who are still in absolute denial, despite multiple fines and the DOJ naming kingpin manipulator JP Morgan a criminal enterprise, which is sure as hell helped the mainstream to understand that these guys are not angels. Most of the trolls really have evaporated into the woodwork. So the trouble is that while the COMEX has some degree of transparency, I mean, some degree, albeit about as transparent as any casino, where you know the games are rigged. So, you know, obviously you've got to realize that you're going to lose 95% of the time and you might win 5% of the time. But really, you know, you have to understand that this is a 10 times larger over-the-counter market that is totally unregulated. And I think the final piece of the jigsaw fell into place after we managed to get questions read in the UK House of Commons back in July 2019. And I published details of how to access that, because this was, in fact, we were so surprised that the speaker allowed this. I think you get a lottery of 5 readings that you can possibly get through to the House Speaker on any one particular session. And it's a lottery, and this one slipped through. And I think they regret bitterly that it slipped through. So really what it was about manipulation. It was tabled, it revolved around our aspersions that there's going to be a potential collapse of offside unallocated gold positions, raising bailout concerns. You know, we're trying to hit all the buttons that really, you know, you bailed out these banks once, you realize you're going to have to bail them out again, you realize what's going on, and realize the taxpayer funded too big to fail banks here in the UK are massively involved in this manipulation because they got footprints in the US. And so what that did was actually got me a meeting with Bank of England Governor Andrew Bailey while he was head of the FCA, the Financial Conduct Authority. Now, look, I think it's reasonably important because this brings it right to the mainstream. And I think, you know, you cannot ignore what's happening in government. And at this meeting with Andrew Bailey, he confirmed these difficulties that he was having because he said, look, but Andrew, this is an unregulated market. I mean, look, this is mind-blowing when you consider at a very minimum, and not accounting for all derivatives, we're talking about 15 trillion a year a market. And the specific concern that we raised at this meeting, witnessed by Member of Parliament, Jeremy Lafoy, was the EFP market and the unreported 14-day perpetual forwards. Now, as an accountant, as an auditor, you'd probably look, if you came across a line that said, oh, you don't have to report this because this liability doesn't sit on the books because you can continually roll it forever. You'd probably go, well, no, I'd like to know a little bit more about that, but not the OCC. And actually, 7 months later, after we warned, after much foot dragging, the EFP thing blew up and it forced scramble. So really, look, I think what's happened is we've realized now what's happened is the bank, the international settlements moved in. They were forced to bail out the banks. It was an undisclosed bailout because it didn't involve going to Main Street. But it was about repaying or suddenly finding a lot of unallocated gold. And we know very well there was no unallocated gold at that blow up. And yet hundreds of tons appeared to balance the book. So we know that this is all now being unwound in a scramble. And there's just too much evidence of market manipulation for it to be swept under the carpet any longer, Rob.
Yeah, I agree with you completely. You were on Wall Street Silver recently, and you mentioned the leverage in the silver market, that maybe for every physical ounce of silver taken off the market, it had to be covered by, or it is covered by 500 ounces derivatives. Can you explain that a little bit for our audience and how that actually works? Absolutely.
And I think this also relates to the unwind of the joined at the hip unallocated gold positions, forcing the unwind of unallocated silver positions. So I think that's important to remember. Basel III and Basel IV addresses a major imbalance, that gold's collateralization of US foreign obligations has reached actual historic lows. And really under the covers, I think this is one of the main objectives that Basel III and IV is forced to address. So essentially what we're saying is, look, if essentially the current ratio of gold to foreign debts is around 6%. And this ratio is historically 20 to 40%. So really what the BIS is likely expects this ratio as we move to a physical price to revert to those levels. So following the implementation of Basel III. So it's important when we're talking about silver here, we all have to, when restoring the 20 to 40% ratio of gold to foreign debts outstanding, that easily puts gold at $6,000 to $12,000 per ounce. I mean, that is simply without doing anything else. That is, but that's simply because we're now losing this paper dilution. But where does that put silver? And I think I also discussed this a little bit on Wall Street Silver. So as of today, and I looked at the gold silver ratio today, is 68 to 1. And so even in the unlikely event that the House digs its heels in and holds this ratio firm, which is absolutely implausible, but that still puts silver at between $90 and $175 per ounce based on its relationship with gold. However, as gold breaks loose of its unallocated collar, so will silver. And this puts the gold-silver cross closer to 16 to 1. So put a short squeeze on paper silver, and this ratio becomes magnetic. And this is the reason I see really silver's 2023 year potential to be significantly higher.
Okay, fantastic. Thank you for explaining that. I want to wrap up a little bit here in the interview with talking about Kinesis, because they've recently become a sponsor of our program. And the reason we wanted them as a sponsor of the program is because we believe in things that are backed, currency or a token or a trading mechanism that's backed by gold and silver. And we've looked at the private cryptocurrencies and you know, I have a tech background, so I can understand how they work at the computer science level. And I have all sorts of concerns over Bitcoins and things like that. But when I look at Kinesis, I see all sorts of benefits. From your perspective, why did you get involved with them? What is the how and the why for you of why you like Kinesis and why you became a part of that team?
Yeah, I think, and one of the good things is Kinesis has been so well received. And I think it's, you know, it is useful to see a plethora of alternative gold coins and tokens on offer, I think, because it draws attention to gold, to the general mainstream. But I think what Kinesis does is to incentivize the use of gold and silver as money. And so because in order to do that, you have to defeat Gresham's law. which is
Mhm.
bad money drives out good. And by sharing the fees generated by the ecosystem, it incentivizes kinesis to be used as money. So in fact, as a bit of a progress report, as from January to May, kinesis has already evidenced 8.3 billion in transactions. We've got 70,000 registered users and growing exponentially now. Kinesis, look, is unequivocally the cheapest place to buy and redeem your physical gold and silver. So even if you don't, first of all, get the monetary system, how this becomes money by digitizing gold, putting it on the blockchain, having it audited, making sure it's in your name, even if you don't get that at first, and the fact that you can share in the fee pool by simply using it, instead of paying your bill with a fiat currency, you pay it with a kinesis, even though it's just simply the cheapest way to go and buy and redeem your silver. So I think how I got involved initially was, look, I think it was, and I've said this before, but essentially, I did a presentation with my lawyers after many years of the CFTC not doing anything in June. This is why it's appropriate, because it's exactly 10 years, almost to the day. I think it was 14. Basically, we did a presentation with my lawyers at the DOJ in DG. We did DJ. We also did it in New York, and we did it. Basically, this presentation said, "Look at these. Here's a big presentation. Look how far up the chain this goes to board level." And we gave 88 examples of where the gold price was going to be fixed, and it was audited, put in writing with the lawyers before it happened. And there was no doubt in anyone's mind that this was clear evidence. We also provided where this evidence came from. But the last words that rang in my ears, Rob, was, yeah, well, what about the economic consequences of this? Clearly, it had gone too far up the line. This is the too big to fail taxpayer-funded bonds. So, okay, it's been 10 years. I don't think it's a coincidence. And I'm sure there is a God, because I walked out of there thinking, damn it, how do we take responsibility ourselves? And I walk into Tom Coggan. He just started the allocated bullion exchange, which is exactly at literally the 2 weeks as I walked out of the DOJ. There was the solution right in front of me, the allocated bullion exchange, the first institutional grade electronic physical exchange. And so basically what happened was, long story short, it required to get a physical global exchangeable price. The gold and silver are fungible if they're in the right quality format, if they're in 4 nines, if they're fungible. So you can exchange a bar from across the globe. So we put together several global hubs to aggregate a physical price, which then by itself brought in a fair arbitrage position, where if you had a too cheap a price in one hub, it would then marry up and someone would arbitrage it into a global physical price. Now, without kinesis, was always on the plans to digitize physical gold, but you cannot digitize physical gold. If you're using a spot price, it's a paper price. No one's going to sell it to you at that price. So it was so important. Before, kinesis could never have been born without the allocated bullion exchange creating vaults, being audited, earning a good reputation, and then kinesis was launched. And I think that's why I'm so excited about the result of this, because it is doing everything we ever wanted it to do, which is for us as people to take responsibility for our own, for ourselves, and to find something that works, that actually solves the problem. And by us using this, we're buying physical, and we're using physical gold, we're using physical silver to square up transactions. It's become money again.
Yeah, my personal experience with storing physical gold and silver, I had a company over in Asia that I was storing some with, and it was like pulling teeth to get access to that when I needed it, even if I wanted to sell it. And this was in I had a bunch of silver and a potential silver shortage market. It was around that February, March timeframe when we saw what happened to silver, we saw what happened to SLV. And I was selling into that thinking it's going to be very easy. It took me over a month to get access to sell that silver and get my cash out of it. One of the benefits I see with kinesis is it's very easy to get, in and out of gold and silver into various currencies on that platform. And I felt a lot more confident that if I wanted to redeem some of my position, I could definitely do that. And it just seemed like just a better overall process, and that company had developed than what I had seen before. So I don't think I'm ever going to go back to that old model, myself, because it's just frustration. And Gerald Celentes talked about this when he needed access during the last financial crisis to his funds from MF Global and he couldn't get it. Then that taught him the lesson of you got to be careful, who you're dealing with and what company you're dealing with. And I think that's a lesson we can all learn. I learned it personally. And so I like kinesis because I have a lot of confidence, very comfortable with that. So happy to, to have them on the program. I'm going to be doing an actual solo review of the company and the product here for my viewers coming up later in June. So stay tuned to that on the channel. Andrew, since we have you on, any last thoughts that you have for our audience before we sign off today?
Well, I would obviously, I'm so pleased that these channels like yourself are there. It's about bringing information to people that people can decide for themselves, but at least they're getting all the news. You're getting all the different aspects. You've got the people who are the naysayers. You've got the people who are saying, but this is what's happening. And with all of this information, you can make up your own mind. So I think, bottom line, look, we have to take responsibility in our lives for everything. And I think this is when we take responsibility for our own money, we become our own central bank. I think that's the ultimate. And when you follow the money, you always find the source of everything. And yeah, I think we all become a part of a solution, which is what I love.
Yeah. Thank you so much for stopping by the program, Andrew. We'd love to have you back on if you have time in the coming months. I think there's going to be a lot of fireworks with regards to Basel III and some of the things we talked about today. So we'd love to chat with you again.
Looking forward to revisiting you. And let's review all of these things in the rearview mirror.
All right. Sounds good. Thank you, Andrew. Speak to you next time.
Thanks, Rob. Thank you so much.